Welcome back. We are going to be doing the end of the chapter case in chapter 3, and this is really related to financial ratios and using these to make an analysis. So chapter 3, end of chapter case, happens on page 93 in Essentials of Corporate Finance. Inside my Excel file, I have put the income statement and the balance sheet. I have also put the formulas for all of the ratios. So this can be a little study sheet for you. And what we're going to do is we're going to go forward and we are going to make calculations for the ratios and then compare them to industry. So the book has provided you with light airplane industry average ratios, the lower, the median, and the upper. And we're going to calculate for SS Air. So our current ratio. And the way I calculate these in Excel is very easy. I'm just going to link them to my income statement or my balance sheet that I already formulated. So my current ratio is current assets divided by current liabilities. My quick ratio is current assets. I'm going to put parentheses here because I'm going to have it do an order of operations first. Current assets minus inventory, because in the quick ratio we don't include inventory. That can be harder to convert to cash. So we really want to know how liquid we are. Divided by current liabilities. Now my cash ratio, this is just cash. How much cash do we have on hand to meet our current liability obligations? So cash divided by current liabilities. Now when we're talking total asset turnover ratio, we are talking about how do we employ our assets? How are we doing managing our assets? So our total asset turnover ratio is sales, which is on our income statement, divided by total assets, which is on our balance sheet. Now when we're talking inventory turnover ratio, this is going to be cost of goods sold divided by inventory, which is our balance sheet. Our receivable turnover, this is like our cash collection. How good is our credit policy? And so we're going to take our formula. And if you're not sure what the formula is, make sure you flip over here. It's sales divided by accounts receivable. So, equals sales divided by accounts receivable. Now, our total debt turnover. Now, who would be interested in our total debt ratio? These are long-term solvency ratios, which are intended to address the firm's long-term ability to meet its obligations, or financial leverage. So this is a financial leverage ratio. So our total debt ratio is total assets, and we're going to use the parentheses again, equals parentheses total assets minus total equity divided by total assets. Now when we're talking debt to equity, we want to know how much of our company is financed by debt and how much is financed by equity financing. So we are going to take our total debt, which we find on the balance sheet, which is total liabilities, divided by total equity. Now the equity multiplier. The equity multiplier is total assets divided by total equity. So let's go over here. Total assets divided by total equity. Another common measure of long-term solvency is times interest earned, or TIE, T-I-E ratio. There's several possibilities, and this is a common ratio, but we're going to use EBIT divided by interest. So basically this is measuring how well a company can cover its interest obligations. Basically, we've borrowed money, we have interest, and how well can we cover this with what we have, with our regular earnings, EBIT So we're going to go to the income statement. We're going to find EBIT. We're then going to divide that by our interest, which is listed below EBIT. So we can cover our interest with EBIT 5.63 times. Now when we're talking cash coverage, a problem with the tie ratio is that it's based on EBIT, which is not really a measure of cash because EBIT includes depreciation. And again, depreciation is a non-cash item. So what we're going to do is we're going to hit the equal sign, equals, put the parentheses, EBIT plus depreciation divided by interest. And this is more cash ratio, like how much cash do we have to cover our interest. Now, when we're talking about profit margin ratios, these measure how profitable our company is, and these are probably the most common ratios that you'll see. So our profit margin ratio is our net income divided by sales. Net income divided by sales. And I'm going to format this cell into a percentage here. Now, our return on assets is net income divided by total assets. ROA stands for return on assets. So net income divided by total assets. And our ROE is net income divided by total equity. Net income divided by total equity. And when I'm formatting these as a percentage, I'm adding the decimal points because when it rounds, since these ratios are so sensitive, we want to make sure we have at least the 2 decimal points on the ratios. So now the question is, what do you do once you've calculated the ratios? So now we're going to look at SSA and we're going to compare it to the airline industry. Now you want to compare it to something that it's in. I don't want to take the airline industry and compare it to the grocery retail store because it just doesn't seem to make sense because the ratios could be different inside from one industry to the next. So I'm looking at this and I'm looking at my current ratio. I'm a little bit above the median for the current ratio. I'm looking at the quick ratio. Again, I'm a little bit above the median for the quick ratio. So I'm doing fairly well here. In my cash coverage, I'm above the lower, but I did not make the median. So I might want to look into this for my cash. My total asset turnover ratio. I'm above the upper quadrant. So I am employing my assets well. Inventory ratio. So I'm turning over my inventory more than the upper quadrant of the average airplane industry. Now, asset receivable turnovers. I'm also have a higher than the upper quadrant of the airline industry. Total debt ratio. I'm a little bit below the median. Same thing with debt to equity ratio. So now I have the equity multiplier. Again, I'm a little bit above the lower quadrant. My times interest earned. I'm only above the lower quadrant here. And the same with the cash coverage ratio. My profit margin is a little bit above the median. My return on assets is just above the lower part. And my return on equity is not the median. It's just above the lower part. So the questions in the ratio analysis were they chose to compare themselves to Boeing. Is this a good idea? Why or why not? Boeing is probably not a good idea because although both companies manufacture airplanes, manufactures small airplanes while Boeing manufactures large commercial aircraft. There are two different markets for this. Additionally, Boeing is heavily involved in defense industry as well as Boeing Capital, which finances airplanes, which could skew their ratio analysis. The next question says, compare the performance of SS Air to the industry ratios. For each ratio, comment on why it might be viewed as positive or negative to the industry. Suppose you create an inventory ratio calculated by inventory divided by current liabilities. How do you think their ratio would compare to the industry average? Okay, so SS is above the median industry ratios for the current and cash ratio. This implies the company has more liquidity than the industry in general. However, both ratios are above the third quartile, so there are companies in the industry with higher liquidity ratios than S&S Air. The company may have more predictable cash flow or more access to short-term borrowing because of this. If you created an inventory to current liabilities ratio, SS Air would have a ratio lower than the industry median. The current ratio is above industry median, while Quick is also above industry median. This implies that SS Air has about the same inventory to current liabilities as the industry. S&S Air has about the same inventory as the industry median, so the inventory to current liabilities is about the same as the industry average. When I'm looking at the turnover ratio, all of them are higher than the industry average. This means that since all three turnover ratios are higher, they are more efficient than the industry. So basically this is saying SS Air is very efficient in their turnover. That's for accounts receivable, inventory, and total assets. When we get to the financial leverage ratios, they're below the industry median but above the lowest quartile. S&S Air generally has less debt than comparable companies, but it's still within the normal range. And this can be good in times where they may need to borrow some money, and so therefore you want to have a lower than average industry debt if possible. So the profit margin for the company is the same as about the industry median. The profit margin and the ROA and the ROE are both below the industry median, but above the lowest part. So they're above the lowest part, but they could work on their profitability ratios. Overall, performance seems good, although liquidity ratios indicate that at a closer look might need to be here. We want to make sure, I think I said in class, that cash is king. So we want to make sure that we have enough liquidity to cover our obligations. So we would look into this as a company based on this ratio analysis. You're also able to watch Inside Inkling Chapter 3 narrated slides, which helps give you some more information about financial ratio analysis. And this will be a good test to practice or look at prior to doing your group activity for the case assignment for the healthcare finance case.